episode of the Practical Planner podcast. I'm your co-host, Thomas Kopelman, here with Ann Rhodes, and Chris Nason is with us again. And if you listen to the last episode, we really teased that today we're going to talk about SLATs. It's something that's been brought up many times, and as a financial advisor, it's probably something many estate planning attorneys have brought up with your clients. But before we get into it, we want to stay relevant and talk about things that are going on. And if you are an advisor listening to this, you probably are on social media. And a couple weeks ago on Twitter, there was this whole big thing from non-practicing attorneys talking about trust that can be used to basically dodge all taxes. And so all these people got in, there's all these tax preparers or CPAs out there that are basically saying like, this is wrong. There is no tax law to prove that this is true. And there's all these people out here that are really like shelling this on videos and on social media, trying to say it does work. None of them are lawyers somehow, that makes sense. But the person basically said that it has 5 parts. That this is how it works. It's non-grantor, it's irrevocable, it's complex, it's discretionary, and it's a spendthrift trust. And then they also talk about how you basically can put in like real estate or put in other passive income sources. And as long as it's classified as some type of dividend, what's the exact term?
Extraordinary dividend.
Extraordinary dividend that you owe no tax. And so I'm not going to pretend to be the expert here. I think I learned 3 new words just in that. So I'm going to hand this off to you, Chris, and just let you kind of talk a little bit about why this doesn't make any sense.
Sure. So, this is kind of at the level of sovereign citizen stuff. It's a really deep misunderstanding of the tax code. The tax code is super complex. It's occasionally difficult to understand. But if you take one sentence completely out of context, you might be able to get to this result. But let's sort of step back a minute. I'll explain briefly how trusts are taxed, how this purports to tax them, and then how the real result should be and why the real result isn't what the promoters claim it is. As an aside, anytime you see something that's just too good to be true, you know it's probably not the case, right? I have an inbox full of emails from Nigerian princes that just aren't right. But when you have a non-grantor trust, the trust is taxed as an individual under 641 of the code. And so with a few exceptions. And so the trust earns income, ordinary income, capital gains income. It pays taxes on that income, on that capital gains. When the trust makes distributions to beneficiaries, beneficiaries receive assets from the trust, obviously. And the trust receives a distribution deduction for the amount of assets that it's paid to the beneficiary. So simplifying slightly, the trust earns $100 of income. It distributes $50 to the beneficiary. The beneficiary pays income taxes on $50 of that income as though he or she had earned it. But the trust gets an offsetting deduction for that $50. So it's only taxed once, it's not taxed twice. But the trust's distribution deduction is limited. And it's limited to what's called distributable net income, or DNI. And that's the amount of income that the trust has earned in the year. And under traditional principles, capital gains, extraordinary dividends, aren't treated as trust accounting income. They're treated as corpus, as part of the principle of the trust. And so if the trust receives capital gains and then capital gains aren't counted as part of distributable net income unless they're actually distributed to the beneficiary. And so the way that this code section works is in referring to the calculation of distributable net income, which is how you determine the size of the distribution deduction that the trust will receive. Code section 643B says that income constituting extraordinary dividends and taxable stock dividends shall not be considered income. But it's not income for purposes of taxable income. It's income for purposes of distributable net income. And so it has nothing to do with the taxation of the income received by the trust. It really relates to the distribution deduction received by the trustee when they pay money to the beneficiary. It's almost like walking to a street corner and seeing a sign that says, don't walk, and saying, oh gosh, I should run across traffic, right? Like the point of the sign is not to encourage you to go fast, it's to encourage you to stop. And I think maybe the reason that these trusts haven't been as audited as perhaps they should be is that the IRS has been woefully underfunded for the last 15 years. And so if no one is reporting income on the tax returns, maybe it's not been noticed. But about a year ago, the Office of the Chief Counsel of the IRS did put out a memorandum outlining this sort of trust, this sort of strategy, and going line by line through the code to explain why this doesn't work, which is unfortunate for those of us who don't like to pay taxes, but probably fortunate for the fisc.
So it's really funny that you say that, because I did find the Forbes article going into this, and it came out in like August of last year. So it's funny that there's like a lot of the supporters and the people using it were the people arguing on social media about why it works. But they all go back to this guy. His name's like what? Don. I think his last name's Don. They think he's like this great person. He knows all the stuff about it. They charge $30,000 to $40,000 to set this up. And then basically it goes into to just say that this has never been through an audit. They have no idea if this works, but it doesn't for exactly why you said. So it's funny to me. I don't really understand how people are still utilizing this structure. And let's say you did, how do you really get out of that structure? Do you just accept it and accept that you pay taxes now, or where do you go from there?
Yeah, I mean, I think to the extent you've been placed into one of those structures, it's not a horrible structure in that, you have assets in a trust that is potentially remote from creditors. I think you weigh your options, consider filing income tax returns from prior years, or take a chance, but certainly in ongoing years, file the way you should be and properly, because you're not paying taxes on capital gains.
Right. I mean, because these are quote unquote copyrighted trusts, I don't think I've ever seen the actual, how the sausage was made. I've never read one of these trust agreements, but at least based on some of the descriptors, which all sound, really good and very complex topics, right? Like it's a non-grantor, irrevocable, complex, discretionary spendthrift trust. I mean, for what is it, one, two, three, four, five of those descriptors, for any irrevocable trust that I would have designed to do estate tax planning or asset protection planning, I would have used at least 4 out of those. And the only one that I might have varied would have been the non-grantor part, but that just depends on whether or not you want your grantor to pay the income taxes generated by the trust, or you want the trust itself to pay for its own income taxes. So really that one is toggleable in a lot of trusts as well. Irrevocable, that's just a gifting trust, like any gifting trust really should be irrevocable. Complex, it's a little difficult to understand what complex might have meant, but in the trust context, particularly when you're talking about taxable income, income of trusts, complex versus simple is just about, I think, whether or not the trustee can retain, discretion as to those distributions or must make distributions. Chris, correct me if I'm wrong, but that simple versus complex is really just about a code section that is about DNI. That the way to calculate that deduction. And then there's discretionary, which I think kind of goes with complex anyways, right? You want the trustee to retain full discretion over the trust. That's what I assume it means. And then spendthrift has to do with like trust law of the state where the trust is set up, so that hopefully you get some asset protection over your trust, which we would have done anyways for any of these gifting trusts that I would have set up. So it's a little, difficult to understand what is the magic sauce here.
Well, the magic sauce is a aggressive reporting position, I think. I think here the spendthrift also refers to the settlor's power to receive assets back, but not have them subject to his or her creditor claims, which is a unique thing sometimes.
Right, and only a few states really allow for
Exactly.
that. And at your state, you know, for your settlor, your grantor, the person who's setting this up, certain states, their home state may not also respect that asset protection feature, right? So if you're here in California and you know, you have a big judgment coming after you, and you try to set up one of these trusts in Alaska or Nevada because they have local laws that are much friendlier to asset protection trusts, like self-settled asset protection trusts, California's courts may just say, too bad, we're still going to look through and reach the assets. So.
And it's funny because you see every now and then people have copywritten trusts, and they've gone through some sort of process to get the verbiage copywritten, but I've never seen one that works. That doesn't mean they're not out there, but it's a huge red flag that someone's gone through the trouble of copywriting it. And I think that gives a veneer of respectability in a way that probably isn't warranted.
It's like having a patent on your invention. Maybe because the government put a stamp on it, like it means something works.
So moral of the story is this doesn't work. It has enough terms that are confusing enough to get people who are like, oh, I make a lot of money, I don't want to pay taxes. Great, let's take this structure. And they don't really have any way to prove quite yet, other than, the IRS coming out and saying this doesn't work. There isn't actually failed audits yet, probably something that are going to be coming in the next couple of years. But moral of the story is, if it sounds too good to be true, it is. Every single person in the world would be using a structure to avoid taxes, and the IRS would change the tax law in that coming year. Like, there's just really no way around it. Okay.
So now let's talk about trusts that do work.
Yeah.
If set up properly, they do work.
Perfect segue. So let's talk about SLATs. I alluded to this in the beginning, super common strategy, really popular trust today. Let's first just start off, Chris, with, what really is a SLAT and why are they so attractive in today's environment?
Sure. So a SLAT is really just an irrevocable trust of which the settlor's spouse is a beneficiary. And so they're called spousal lifetime access trusts, because trust and estates attorneys love acronyms. But it's, can be a dynasty trust, it can be a non-dynasty trust, it can be a grantor trust, a non-grantor trust. Any trust that has the settlor's spouse as a beneficiary is going to be a SLAT. Almost always, the SLAT will be a grantor trust, which means that the settlor is going to be responsible for the income earned on the trust. And the advantage of the trust is it provides sort of a break glass in case of emergency situation for assets that you give away. If you've given, lots of money to a trust and the only beneficiaries are children or other third parties, you're not getting that money back. Even if your children take distributions and give it to you, they've made taxable gifts, and so it becomes very inefficient. Generally, you yourself can't be a beneficiary of a trust. But if your spouse is a U.S. citizen, he or she can give you unlimited gifts for free. And even if he or she isn't a U.S. citizen, if your spouse uses distributions from the SLAT to fund living expenses, you can certainly live in your house as the guest of your spouse, and your spouse can provide food for you and clothing. And so they're very popular among people who are potentially worried that they've given away too much, or that they're going to, for some other reason, need assets back in the future.
And Chris, we had a recent episode about marital trusts and how they are specifically designed to fall under this code section, the QTIP rules, or Qualified Terminable Interest Property Rules 2056B7, so that they take advantage of the unlimited marital deduction. The SLAT that we're talking about is a little bit different, because here you're saying it can be structured in a very different, like all sorts of structures could fall under the SLAT umbrella. And specifically when we're talking about taking advantage of the doubled exemption, you actually want your SLAT to not be a QTIP trust necessarily, because you want to trigger the taxable gift.
Correct. And actually taking distributions from this trust, because you've either paid gift taxes or applied gift tax exemption to set it up, means that if you take distributions, or if distributions are made to your spouse, it's tax inefficient because it brings it back into the marital estate. And so it really is, like I said before, an emergency source of funds, but not intended to be used regularly.
So, can you talk me through a little bit from a financial advisor's perspective? Let's say you're thinking, this might actually be really interesting for my client to set up. What are the things that the financial advisor can do to make sure that this is the emergency fund aspect of this does not get triggered, that you're not overfunding the SLAT because, there are downsides to overfunding. You have to live now with this trust structure interposed between you and your spouse so that you guys can continue living your lifestyle, but then now the trust has to distribute money and maybe you have to pay income taxes as a settlor on the income within the trust too, without necessarily the liquidity of it. So like, what do you think about as a financial advisor?
Sure. So I think the first thing is realizing that SLATs aren't perfect because there is a certain built-in mortality risk and a certain built-in divorce risk that comes with establishing any SLAT, right? Happily married, you think you're going to last forever, and suddenly your spouse gets hit by a bus, you're not getting that money out again. Also, you get divorced. Suddenly your ex-spouse is a beneficiary of this trust. There's ways around both, which can involve making, instead of, Mary or Susan, the beneficiary of the trust, my spouse, which means that whomever I'm married to at the time is a beneficiary of the trust, which reduces divorce risk, reduces mortality risk, but requires you to have a spouse. So it's not perfect. And so realizing that it's not a perfect vehicle, I think the considerations that come in when you make any sort of big gift to an irrevocable trust are there. So what are your assets? What do you expect to earn in the future? What do you need to live on? How much are you comfortable with giving away? This might help bring you closer to that limit because you can always get funds back and make you sleep better at night. But it's not, I have $7 million, I'm going to put $7 million into a SLAT.
So what I'm hearing is if your clients are interested in this, but one of the spouses is like a big wave surfer or something, likes to do really risky stuff, you stop your spouse first of all from doing those things. And that if you don't have a spouse anymore, you better go and get engaged pretty fast if you want to access the assets. But all joking aside, I also think one of the things that you mentioned earlier is this trust is mostly set up as a grantor trust. Now, is this because of how the tax rules work and what you're trying to achieve here, or is it truly a choice of the settlor? Because then it also affects, our financial advisors who are listening, in terms of having to put into the cash flow some income tax estimation.
Sure. So, as a general rule, the tax code says that if you set up a trust where the income can be paid to your spouse, the trust will be a grantor trust. There's some complicated structures you can put in place where you have another beneficiary consenting to distributions to the spouse, which have potential gift tax implications to that beneficiary. And so as a general rule, the trust is a grantor trust because of because the spouse is a beneficiary. Income tax considerations are less significant here if the clients are filing joint returns, as most married people do. Because, again, the grantor would pick up all of that trust's income on his or her return. They'd owe a certain amount of taxes, but it's reasonably easy to make a distribution to the spouse, and then he or she can just write a check to the IRS in that amount.
That makes sense.
That makes sense.
I have a question back to one thing we were talking about before, though, with like naming your actual spouse or naming like your spouse. What would be the considerations why you wouldn't just do that every time to be safe, of like not actually naming somebody?
Marital considerations. I'm married to my spouse, and my spouse might get annoyed if I say, I'm not going to name you as a beneficiary. I'm going to take, what is essentially marital assets, what is essentially our property, put it into a trust, and I'm going to name the person I'm married to. Maybe it's you, maybe it's not you.
So it's all optics. You just don't want to look like the person who's like, hey, just in case you're not here. Okay. That makes sense.
It's optics, but it's also genuine, right? Like if that person knows that in the case of a divorce, that person may or may not still be a beneficiary of that trust. It may or may not have those assets available.
And the other thing that kind of is a good segue into, I think, is also when you have these conversations with the spouses, the couple, there are some, it can be a very delicate conversation, right? Mortality, risk of divorce, etc. But also, do the spouses even set reciprocal trusts up for each other? And how reciprocal are they? Because there are some tax rules that stop you from doing complete mirror trusts for each other. It's like, if Chris, you and I were married, like I set up my trust for you, honey, and then honey, you set up the exact same trust back for me. Walk us through some of those considerations too that can make that conversation a little tricky.
Sure, and you've obviously quoted the reciprocal trust doctrine, which does collapse trusts if they're set up by the same people for the same beneficiary or for themselves as beneficiaries. And so ideally you'd set up just one SLAT. Like you'd pick the spouse who has the greater earning potential. He or she would set up the SLAT for the so-called poorer spouse. And then the idea is that if one of them were to pass away, they would both be fine. The higher earning spouse would continue to earn, or the lower earning spouse would have this pool of assets set aside. If you really wanted to do two SLATs, you would think about doing them well apart in time. So you do one, this year, and then well in the future, do a second one. So it's not as though the trusts were created with consideration for each other. The other thing you can do is really vary the terms. So trust one is for this set of children or grandchildren or charities. Trust two is for a different class of beneficiaries. They can both have the spouses, or they have different withdrawal rights, or they have different termination periods or different dispositive terms. But the more different the trusts are, the less likely they are to be collapsed.
So it's basically most times different states, different years, different assets, different beneficiaries.
States is less important, but different terms, certainly. Different terms,
Okay.
different beneficiaries, different assets, different times. The more differences you can have, the much more difficult it is for the IRS to say these are the same trusts.
So let's say you were thinking about it this year and you wanted to be able to, use a lot of an exemption and you'd ideally like to use two SLATs. Do you think state would have any added value if you wanted to basically have to do one this year and next year, or no?
I suppose if you did one that was, again, in a state that had an extraordinarily long perpetuities period and one that didn't, that might bring you some advantages. Although having said that, you might not want to set up any trust in a state that has a short perpetuities period.
Right. Or be subject to income taxes in that state, right? So if you were setting up one in California and one in Delaware, they're very different friendliness
Sure. Although as grant flow trusts, you'd be paying at least during your lifetime the income taxes personally.
right.
That makes sense. I have a question. So, can we maybe go through an example of like a scenario? Maybe you don't have to use a client situation you have, but like maybe make one up of like a family where this could make a lot of sense. And then I would love to kind of walk through. We talk about like, yeah, these are great, but they're typically still emergency type uses. When are times and ways that people have leveraged these trusts?
Sure. So I think the prototypical situation would be, a client with, say, $30 million, you know, reasonably young, still earning a lot of money, but for whom giving away, the exemption amount, as we discussed last time, is 13.61 million, 14 next year, for whom giving away 14 million is still painful. And so you would say, well, you can make the gift to this SLAT, fully use all of one of the spouse's exemptions. And if everything goes right, this 14 will grow to 100 GST exempt by the time one of you passes away. And so it's, outside of your estate and a great gift for your children. But again, you're still relatively young. Who knows what the future is going to bring? If things don't go well, the business collapses, there's creditor claims that are unforeseen. your spouse can take distributions from this to sort of bring you back to the level of standard of living that you were at in the past. And again, ideally, you wouldn't touch it, but you would have the option. One way to do that would just be to take outright distributions. Company went bankrupt. I had pledged the house. Now we have nothing. Let's buy a new house. Ideally in the SLAT, but we could take money out of the SLAT to buy the house. Or we're running through a rough patch now. We need a bit of cash to, pay the kids' school fees or something. The spouse can take either a distribution or a loan from the SLAT. And the advantage of a loan is that he or she could then repay the loan when things got a little bit better.
What's the downside of taking the distribution?
Taking a distribution puts the assets back into the spouse's taxable estate. And so, under the normal course of things, one spouse will pass away, all of his or her assets will go to the other spouse, no estate taxes because of the marital deduction. Then the second spouse will pass away, and there's that 40% estate tax on his or her assets. To the extent that he or she has taken money out of the SLAT, brought them back into her own hands, the estate tax is greater. Everything that's in the SLAT is not subject to estate taxes. And so you ideally want to die as poor as reasonably possible.
Are there any income tax considerations too to taking distributions, or not really?
During the life of the settlor spouse, it's a grantor trust, and so distributions would be tax-free. Following the death of the grantor spouse, the settlor spouse, the trust would become a non-grantor trust. And so, as we discussed at the top of the hour, the trust would receive a distribution deduction for the transfers to the spouse, and the spouse would pick up that income on his or her tax return.
Right.
Okay. So moral of the story is the downside is really that you use this exemption, you got money in there, it's growing out of your estate. So when you withdraw it, you used exemption, but you're getting money back into your own name. So it's not the end of the world to use it. Like, let's say your goals change, right? Let's say, you thought you wanted to spend this amount, you're getting a little bit older and you're like, oh, I'd love to buy, a couple vacation properties and really spend way more on your life. The downside is that if you're way over the estate tax exemption later, you're going to have more taxes, but there really isn't a huge downside to you personally in your life while you're alive, or like tax issues that you face.
That's right. And you could also consider having the trust itself by the vacation property. While the beneficiary spouse is alive, he or she can use that tax-free, and you as the settlor spouse can come along as a guest.
Okay. That makes sense.
So I have a question that I think may be bordering on controversial to close out this episode. Chris, I am curious, do you think that right now in the estate planning industry, because these SLATs seem like such a good answer to, being able to use your doubled exemption, not being too afraid, that something could go wrong and you've given too much away, as long as you're happy in your marriage. Do you think that there are kind of like SLAT mills out there right now where they're just being sold as like God's gift to high net worth families? So to encourage them to do this planning and live with these SLATs in the long term?
I think including your spouse is very helpful. So to the extent people are encouraging that, it's not a bad thing. I think there's certainly people who are much more aggressive about the reciprocal trust doctrine that we discussed earlier than might be otherwise reasonable. And so encouraging people to set up the identical trust or trust with just very small differences, which is always dangerous.
On that note, Thomas had asked a question about state variations and whether or not the state factors in. Do you think that this technique works very well for folks who live in certain states versus others? And I'm thinking particularly community property states and how that factors into how to structure the SLAT.
Sure. So to the extent you fund a trust, it should only be funded with your separate property. And so, in California and other community property states, title doesn't really matter. Instead, each spouse owns essentially 50% of all of the marital assets. And so if you have, $30 million of assets, you can transmute them so that each spouse has personally 15 million in his or her name, and then one spouse can give away all of it. If you don't have that much, say you only have 14 of community property, you transmute it, and then one spouse gives to the other spouse, who then immediately takes that money and funds the trust. You've opened yourself up to an argument that the beneficiary spouse really was the funder, the settlor of that trust, and so potentially includable in his or her estate because he or she's a beneficiary of a trust that he or she funded with their own assets. And so again, a bit of time and a bit of thoughtfulness about that.
So, I mean, I guess last question, do you feel like this is the most common irrevocable trust that you're seeing set up today? Is this the most used?
That's a great question. I think it's the most used by people who are worried that they don't have enough to give away. I think people who have, well in excess are happy to just take that 14 or more, put it in a trust, and then have the flexibility to easily turn on or turn off grantor trust status. Again, grantor trust status is triggered by powers that you, the settlor, have over the trust. And so if your spouse isn't a beneficiary, you can quickly toggle that on or off if the income taxes become too intense. If your spouse is a beneficiary, your spouse needs to be removed, which is potentially tricky.
That makes sense. I think the point you made though about like the people worrying about money is really interesting because I feel like that's probably a higher number than the average person would assume. Like I think if you talk to the average person who makes a couple $100,000 a year, they're like, what, somebody has 10 to 30 million dollars and they're worried about running out of money. But in my experience, everybody I talk to in that space is worried about whether they would have enough money and that they don't probably want to move dollars outside of their estate.
I think that's right. I think you need to have generally, in excess of a few hundred million before you're comfortable giving away 30. But again, it depends on the people.
Yeah. And this is where, for our financial advisors who are listening, this is where you, knowing your client, what their objectives are, how they live their lives, who their beneficiaries are, and then doing some of that like cash flow planning. This is, where the conversation is so important. Before you set up any of these irrevocable trusts, understanding your client is what underlies and underpins all of these strategies. So yes, we've explained a couple of interesting, planning strategies around especially the Tax Cuts and Jobs Act sunset. But to be honest, the work starts with you, understanding who your clients are and what they're willing to give up, what they need to live with, how old they are, what their, trajectory is from an earning potential perspective. And then, only then, sort of considering what could be good options.
Yep.
Yeah, these are very powerful tools, but they need to be used appropriately, depending on the facts and circumstances.
Unlike the trust we talked about at the beginning, right? Perfect way to end it. So everybody,
okay, don't do that one. do another one.
Don't do that one. But Chris, we really appreciate you coming on and diving into the weeds on some pretty advanced stuff. So thanks for the time, and everybody, thank you for listening. Again, we're putting a lot of time and effort into this podcast. So please rate and subscribe. And if you have any topics that you want us to talk about, like the one we did at the beginning of this episode, feel free to DM us or go submit it online, and we'll make sure we add it to the episode. But we'll see you back in a couple weeks.